Nobody actually owns Facebook. Not in the way you'd expect. 2.9 billion people log into it every single day. And yet one man can outvote almost every other shareholder combined, using a mechanism most people have never heard of, the dual-class share. Here is how it works. Meta issues two kinds of stock. Class A shares, the ones the public buys, get 1 vote each. Class B shares, the ones Mark Zuckerberg mostly holds, get 10 votes each. So, while Zuckerberg owns roughly 13% of the company's total stock, those Class B shares hand him somewhere around 60% of the voting power. 60%. Which means every other shareholder on Earth combined, from index funds to pension funds to you, could vote against him, and he would still win. That single structural decision, made before anyone believed this company would be worth over $1 trillion, still shapes almost everything strange about how it operates today. And by the end of this video, you'll see exactly how far that control reaches. To understand what you're actually buying when you buy a share of Meta, forget the apps for a second. Facebook and Instagram are free. There is no subscription fee, no checkout page, no monthly bill. So what is the product? You are. Or, more precisely, your attention is. Meta's real business is buying nearly half the human population's spare time in 3-second increments and reselling it to advertisers who will pay enormous sums to interrupt it. In 2023, that resale generated over $134 billion in revenue. More than 98% of it came from advertising alone. Not hardware, not subscriptions, not the Metaverse everyone joked about. Advertising. Every scroll is a tiny transaction you never see and never sign. Now here's the part that made this business almost unfairly profitable. Building a factory means buying machines, land, and raw materials before you sell a single product. Building Facebook meant buying almost nothing. In 1984, when Zuckerberg was coding the earliest version from his Harvard dorm, the entire operation ran on a few $1,000s of rented server space. The real cost only shows up once you try to scale to 1 billion users. And even then, the cost of serving user number 2 billion is barely higher than serving user number 1. Economists call this near-zero marginal cost. And it is the quiet engine behind almost every eye-watering profit margin Meta has ever posted. But scaling that dorm room project into a global company needed outside money. And the deal that made it possible still sounds almost too simple to be true. In 2004, a venture capitalist named Peter Thiel looked at a website with a few thousand college users and decided to write a check anyway, $500,000 in exchange for roughly 10% of the company. At the time, people close to the deal reportedly questioned whether Thiel had lost his mind. Today, that stake would be worth tens of billions of dollars. It remains one of the most lopsided bets in the history of venture capital, and it is the reason Facebook survived long enough to become the company we're talking about now. Money brought growth, and growth brought a very different kind of cost. People and machines at a scale almost no other company on the planet has to manage. At its peak, Meta employed more than 87,000 people. It still spends close to $28 billion a year just on data centers, the physical buildings that store every photo, video, and message billions of users generate daily. Here's a way to actually feel that number. $28 billion is roughly what it would cost to build 3 new international airports every single year just to keep servers running. That is the invisible price of a free app. So how does something this expensive to run still print tens of billions in profit? The answer lives inside a process most users scroll past without ever noticing. And it actually happens in 2 separate steps, not one. Step 1 is targeting. Meta's algorithm decides who you are based on years of behavior and sorts you into an audience an advertiser can select. A gluten-free bakery in Ohio, for instance, can choose women aged 25 to 40 within 5 miles who've searched gluten-free recipes. Step 2 is the auction. Once that audience is defined, dozens of advertisers who want to reach the same group essentially bid against each other in real time for the right to show you their ad. Meta's system picks the winner based on who pays the most and who you're most likely to actually engage with. Both steps together, targeting and bidding,
happen in the milliseconds between you opening the app and the first ad loading. Advertisers aren't paying for eyeballs. They're paying for outcomes. And that distinction is worth more than almost any other form of advertising ever invented.
But a machine this efficient has a weak point, and it isn't hidden in a boardroom. It's sitting in your pocket. Meta doesn't own the phones its apps run on. Apple and Google do, and they control the rules. In 2021, Apple flipped a single privacy switch, letting iPhone users block apps from tracking them across the internet. One settings menu, built by a rival company, and Meta later estimated it cost them around $10 billion in lost revenue in a single year. Not from a lawsuit, not from a scandal, from a checkbox. If that sounds bad, regulators have been worse. In 2023, the European Union hit Meta with a record $1.3 billion fine for improperly moving European user data to the United States. That's on top of a growing pile of antitrust investigations and congressional hearings, but have quietly become a routine operating cost. One that never shows up cleanly on a balance sheet, but shapes nearly every product decision the company makes. And underneath both of those threats sits a slower, quieter one: relevance. Facebook, the original app, has been steadily losing its grip on teenagers for years. They're not opening it. They're opening TikTok, which is why Meta poured billions into building Reels, a feature that borrows heavily from TikTok's format, essentially racing to copy a rival before that rival eats its lunch. It rarely makes headlines, but defensive spending like this might be one of the most important survival moves the company has ever made. Which brings us to the biggest gamble in Meta's history, the one that made investors nervous and the internet very entertained. In 2021, Facebook renamed itself Meta and announced a massive bet on the Metaverse, a virtual reality universe most people never asked for, and so far have not shown up to. Between 2021 and 2023, the division responsible for building it, Reality Labs, lost an estimated $46 billion. To put that in perspective, that's enough money to have paid the entire NFL, every player, every team, roughly 5 years' worth of salaries, and Zuckerberg spent it chasing headsets instead. Why bet that much on something so unproven? Because owning the next major computing platform, the way Apple owns the smartphone, means owning the toll booth for decades to come. It's a wager funded entirely by the advertising machine, and whether it ends up looking like genius or one of the costliest miscalculations in tech history is still being decided. Here's what makes that bet possible at all. Nobody can stop him from making it. Because of that voting structure from the very beginning of this story, Zuckerberg cannot be outvoted, cannot be fired, and cannot be forced to abandon the metaverse, even if every other shareholder wanted him to. Despite fines, lawsuits, an Apple-shaped hole in its revenue, and tens of billions burned on VR headsets, Meta still reported a net income of over $39 billion in 2023. Pure profit, after paying every one of those costs. Few companies could absorb that much financial punishment and still walk away that far ahead. Zuckerberg's $1 salary is almost a joke next to it, because his real compensation isn't a paycheck. It's a stock price that can swing his personal net worth by billions in a single day. That resilience didn't happen by accident, and it wasn't built without scars. Facebook nearly missed the shift to mobile phones entirely, a mistake Zuckerberg has publicly called one of his biggest regrets. Move too slowly, and a company this size gets left behind, but move too fast, and you get the opposite disaster. In 2018, the Cambridge Analytica scandal revealed that a political consulting firm had improperly harvested data from up to 87 million users, a breach of trust the company still hasn't fully outrun. Somewhere between too slow and too fast is a line every trillion-dollar company is trying to walk, and Meta has stumbled off both sides of it. If you own an index fund, a 401k, or almost any broad retirement account, there's a decent chance you already own a piece of this story, whether you've thought about it that way or not, and that's really the point. Owning Meta doesn't mean owning factories, oil fields, or warehouses. It means owning a business with almost no cost to scale, an advertising engine efficient enough to absorb a $10 billion shock and still post record profits, and a founder who cannot be removed no matter how his biggest bets turn out. It is a company built on something you cannot see or hold, just human attention, captured billions of times a day and converted into one of the most valuable assets on the planet.
Which raises the real question this whole story has been circling. If the most valuable thing in the modern economy is a few seconds of someone's attention, who actually owns yours?